So I think we're going to start the next session. So the next session is one of the big topics in risk management at the moment, which is liquidity risk management. And we have a presentation now looking at liquidity risk management and the Basel III impacts of the new liquidity regulations and requirements, and the implications also for the whole liquidity risk management process. And this presentation will be given by Philip Bethell, who is the Chief Marketing Officer and Head of Solutions Consulting at Polaris UK. Phil is a Treasury Capital Markets, has been in Treasury Capital Markets and risk SMEs with over 27 years experience in investment banking. He began his career in the mid-80s with Barclays Azut Ved, which was the forerunner of Barclays Capital. And then he moved into market risk management in the 90s, where he helped create methodology and the calculation to monitor the inherent risks in the bank's options book. So someone who is highly experienced and definitely an expert in this field. So I would invite Phil to start.
Okay, good morning everybody. I know I stand between you and lunch, so hopefully I'll keep this brief and to the point. Unfortunately, I've got half an hour for this. So, if it works. Right, back one. So what I'd like to talk to you today about is, as was stated, Basel III and liquidity risk management, but also the whole coverage of that aspect, from full data management into the proactive management of your process. And basically that's what it's got to be nowadays. You can't be reactive to the market. You can't wait for reporting to come to you. You have to know what is going on within your underlying processes. You have to be able to manage it proactively and manage the exceptions within the market, within your bank, and be able to report to your regulators what is going on. They're not going to stand by and allow you discrepancies. To give you some idea, in New York, they are now running scared of the Fed. They are expecting someone to be fined as and when they go compliant in 2015. They are physically waiting for that. Now, they are also coming up with processes to get around how they manage liquidity risk management. Now, we all know that over the last number of years, there's been many things that a bank has to cover, many different risk aspects. And again, this slide is just really to scare you. There's many things that you have to do, many things that you have to monitor on a daily basis. The world is getting larger from the risk perspective. And unfortunately, the regulator has now got teeth. They're not going to wait for you to come up with a process or just be reactive to it. They want you to manage your risk book on a proactive basis. Now, how are they doing this? What they've introduced is Basel. These are the regulatory aspects, the rules, the limits, the metrics, the measures for you to manage your business. They've given you the methodology and they expect you to abide by it. It has been a process that has gathered pace over a number of years, and we've gone through many iterations from Basel I to the present Basel III. Now again, the difference between all of these is that the process up until this date has been very reactive. You've had to basically, potentially, been given relaxation to give you reports on a 30-day basis if you're not following it compliantly. Different countries have had different regulatory aspects. So again, there's country risk aspects coming into the process. But today, the whole process has to be on a proactive basis. You need to be managing what is going on within your balance sheet aggressively. Now, to perform this, they're supplying many different ratios, capital adequacy, many different methodology to help you in that process. They're giving you strict limits that you have to adhere to. Now, there are buffers that they're allowing you to have, but basically, banks are treating those buffers, for example, in the US, as their hard limits. They don't want to have an aspect where they're getting close, or even the rumour that they're getting close to their ratios, because they are in fear that if that rumour gets out into the market, then they could get a run on the bank just through pure advertising of that fact. They believe that what will happen potentially in rumour will happen in fact because of that knowledge out in the market. So basically we've had a number of different rules that have been applied, and as you can see on the screen, we've got the LCR, the NSFR. This is all about managing the concentration of what you have for your funds, managing what you've got to manage the cash to cover a potential deficit for a 30-day period within your bank. Okay? Now, how do they do that? They've given you 17 principles that you have to adhere to. Okay? 17 principles for LRM, and also 14 principles for the aggregation of your compliance data. Also, you have to feed in all of your balance sheet, and this is going to be managed on a daily basis, and you are going to have to report that you have adhered to those limits on a daily basis. As I said, there are country aspects to it, so different countries are going at different progress on this process. By January 2015, the US has to be compliant. They are being more aggressive to the process. Other countries are adhering to different country limits. Again, the UK is controlling what you can move for funding purposes cross-border. So again, you as a bank have to adhere to these policies and have to take them into account, especially if you're an offshore bank operating here in Dubai or elsewhere around the globe. You cannot ignore that country regulatory aspects. You have to also comply with that. Now, we're at an interesting time within the market. Interest rates are low. So basically, that also impacts on your risk in two ways. Because you're looking for duration, you're looking to hold your bonds the longest period for your cash to cover the ratios that you've been told that you have to adhere to. Now, that will impact on your liquidity because you're holding it for maturity. So that potentially drives you to take that bond and make it available for sale because you can get more money. You can invest it short term as a repo in the market. Unfortunately, that will also have an impact on your book because you will then have an inherent risk in that. Not only do you have to manage it because it changes the aspect of the ratio of how it's calculated on your balance sheet, but also you have to make sure that when you repo it out, that you get it back. There's inherent risk in that. But also that someone doesn't sell it by mistake out into the market. It impacts on your limits. It impacts on your balance sheet as a whole. Now, all of your fixed income has a market value. And as you move into certain markets, you may move into derivatives. And again, you start leveraging your position. Again, there's more inherent risk in that. And there's different calculation aspects within Basel III as to how you cover those within your balance sheet. Now, what does that lead to? That basically leads to you being able to realise what is going on within your balance sheet and the pure P&L aspects within that and what you're holding. It's all about cost of funds as to what you hold within your limit and within your buffer. The more you hold, the less you've got to invest in your market operations. And again, that drives your cost of funding up because you have to then hold capital. That equals a cost. Now, the issue with that is potentially you even need to discount your rates to banks that aren't adhering to Basel III yet because they have got a competitive advantage against you, or you have to manage the business that you're performing in more detail. So that forces you to look at funds transfer pricing, forces you to look at where the best profit is being made within your bank. So you need to have detail. You need to have visualization as to where you are earning the profit. And that could be with a customer, a product. You could have introduced a new product to the market. You want to know how it's performing. Because you don't want limit and capital sitting there doing nothing. It's costing you money. But also, it is not giving your shareholders value on their returns. You have to make them happy. So, what do you need to do to actually cover that? What you need is a plan. You need to have a strict policy in place. Not potentially with Basel III, this needs to be internal within the bank. What you need is a quantitative risk management framework. And basically, this is a robust way of you internally setting the limits, setting the performance expectations that you want for your balance sheet. But also being able to stress that performance, being able to do scenarios, basis point shifts, economic shifts, exchange rate shifts, see what effect it has on your portfolio. For example, let's say the Fed rate moves. Do you know how it's going to impact on your portfolio today? How is it going to affect your liquidity? How is it going to affect your performance? You need to know these things in advance and be able to plan for them, be able to hedge your position. It's all about calculating the risk that you have inherent within your book and the tolerances to it. Because your regulator is not going to be too happy if you have to go to them as a lender of last resort or actually say you've broken your limit. To give you an idea, banks in the US are now looking at that buffer as a pure limit. They're also looking at ways to get around it. There's many quants sitting in New York that are coming up with different methodologies. At the present time, the Fed is sitting on the fence as to whether they can use those methodologies to cover their positions. But they're also looking at different ways to calculate, different products to utilise. To give you an example, Deutsche Bank is now linking the dots off balance sheet between lenders and buyers. If someone has got cash and someone else wants a product, they're actually linking those individuals together off balance sheet. So it does not impact on their liquidity requirements, on their LRM. And that requires very strict management and very good solutions to be able to do that. But the whole process now is potentially moving around the fact of what you have to hold on your balance sheet. So there's lots of new methodology that's been adapted and adopted and invented in the States and rolling out across the world. Now, if banks are doing that, potentially you're going to be at an unfair, they're going to be at an unfair advantage. But it's all about rebalancing the portfolio you've got, using it to your best advantage. Now, this leads us to country specific. So certain countries are moving quicker. To give you an idea, the States has to be pretty much compliant 100% by January 2017, and they're being more aggressive on their approach to it. But also, good luck to them, they have large amounts of cash available, large amounts of marketable bonds to utilise on their balance sheet. They are cash rich. Unfortunately, with other banks around the world, potentially around this region, you haven't got so much choice in what you can utilise to cover that underlying ratio and liquidity risk. So again, you have to be more inventive as to potentially how you cover your rollout. Now, how do you manage that? The key thing is going to be the drivers, the sensitivity. What you need, as I said earlier, is a plan. But also what you need is early warning indicators, also known as key risk indicators. So you need to know where there is issue within your balance sheet. You need to know immediately that potentially there is a problem, there is an exception, there is an issue within your underlying trading. But also you need the information to be able to act on that, see what is wrong and come up with a plan, or also have a plan in place, a strategy as to how to cover that. Now, what we're looking at is managing this on an intraday basis. So in the States, in Europe, banks are actually looking at the physical intraday ins and outs. They're looking at the nostro, the vostro, the cash. They're looking at where they can move funds around. You may have a branch sitting in London that has dollar funds that are under, another branch sitting in Singapore that's over. They're looking to move those around and match them and cover positions, utilise their balance sheet. Unfortunately, regulators are now finding out about that. They're now aware of that and they're coming up with restrictions. So there are country risk aspects that you also need to adhere to. Certain countries, you're not able to move those funds around. So again, you need to be able to monitor that within solutions, within systems, and see what is going on. Get awareness, get warnings that potentially staff within the bank have performed that and cover it internally. Now, basically, what a bank should be striving towards is preemptive cover of the balance sheet. It's all about managing proactively. It's all about managing via exception. It's looking at the issues, seeing what is happening before it actually happens, coming up with, as I said, a plan. What you need to do is not get anywhere near your limit. You need to utilise that buffer as a warning threshold. But also you need to utilise it to its best advantage. You need to make money from that buffer. You need to invest it in the best performing underlying products. So again, visually, you need to know what's going on within your process. You need to be aware of issues and also plan, as I said, for the future. You need to be able to utilise your rated risk assets, or RWA. So you need to know what's on your balance sheet, what you're utilising to cover your liquidity position, your capital adequacy. You need to be aware of that you're holding it and not utilise it or sell it on elsewhere. Also, what you need to be aware of is the market moving on you. What you don't want to be in is a position where spread is widening against you. If you're fixed and you've got floating rates and that's going against you, again, you've got an inherent risk there. Also, you need access to funding. So you need to be aware of who are your customers on your balance sheet, who are your relationship banks, where can you potentially get funds from, and where is it sitting within your balance sheet. So you have to have timely awareness of this. And if you lose one of those customers, if you lose one of those underlying aspects to your balance sheet, you need to know about it immediately and replace it. Again, it's not about waiting until it happens. You have to have a plan. Also, as it liquidates, it affects your buffer. So as it's sold on, you need to go out there and replace it because your buffer is being decreased. You can't physically sit there and not replace it. So you've got 30 days whereby you need to get that liquidity back and not breach your limit. So the whole ethos is around coming together with a whole plan, a whole framework of how all of this impacts on your balance sheet. Not only does it impact on your balance sheet, it impacts on your trading book. You can use different products to help you, to assist. But also you need to be aware of what you've got within that balance sheet that's actually covering your position, the LRM that you're holding. Everything needs to be visible. So how do you do that? So basically what you need is a solution. You need to manage this on a real-time basis. You need to have systems which are being supplied with data from your underlying different itinerant systems. Could be trade finance, could be treasury, could be retail. But you need to be known or made aware of everything that's going on within your bank. It's back to the old issue of rubbish in, rubbish out. No longer can you be unaware of what's going on, unconscious of potentially what things are happening in different reporting lines. You need to have a complete awareness in your underlying book. So what you need to have is a liquidity model. You need to have a solution for funds transfer pricing, for ALM. but also linked to a proactive monitoring solution that covers the 17 principles. You need to have those principles sat over your underlying business, and you need to be made aware of what's going on within the coverage of those 17 principles. You have to report on this real time, daily. It's not going to wait for you. If you breach a limit, potentially you're going to get penalised for it. Now, that may not happen so quickly in this region, but Bethell, the Fed, Bank of England, CFA, is pushing this out globally, and they're expecting all banks to adhere to it. Now, it could be overseas branches, but ultimately it is going to impact here sooner or later. So what you need is a complete framework, running all the way down from the top to the bottom and covering everything from your corporate treasurer, your trading desk, and also your back office operations. So all of that information needs to feed in. You need to know what's going on, how it's affecting your liquidity. Have you got non-receipt of funds? How is that going to impact on your balance sheet? Are you going to have to replace it? Have you got creditworthiness issues from customers? You need to have awareness of everything that's going on within your banking environment, because everything now amalgamates together and will impact on that. And again, you may have a buffer, you may be cash rich, fine. But if you're managing it with products on a liquidity basis, your ins and outs, you have to have clear awareness of what is happening with those underlying processes. And again, what you need is a solution that sits on top that is managing everything by exception. If everything's running fine, you don't need to be made aware of it. You need to be told and pinpointed to where the issues are happening. What you want to do is look at the exceptions. And I said earlier, hedge them, square them, look for an alternative source of funding. But you can no longer just sit there and allow it to happen. You have to be proactive and manage that process through. So, how do you do that? What you need to start at is the base roots. All of your underlying systems, your GL, your treasury, your retail, your core banking, what collaterals you're using. All of that system information has to feed up, has to come to you in a centralised place. You need to integrate that, but you need to integrate it sensibly, intelligently. What you need to do is come up with a framework for your product codes, your product types, but how they behave. You may have FX in different solutions across your bank, in trade finance, in your retail, in treasury. They need to come into a combined report, into a combined silo, so that you can see what is going on, the inherent currency risk, etc., within that. So everything has to feed into your ALM, into your FTP. So you can see your match balances, you can see your average rate, you can see what you're earning on, you can see your performance. It's all about visibility and coming up with a decision. You also need to have the methodology, the calculations, the pricing, proactively, real time. Again, markets move. For example, that very nice UBS trader moved the market in Swiss by many big figures. It cost UBS 175 million in an hour to actually replace that, go out in the market and cover their position, and that's just in an hour, okay? You can lose a lot of money as if you are highly leveraged and you're using derivatives. But again, that's just an example. You need to be aware of what's going on within your underlying balance sheet. You need to be calculating this on a real-time basis. As the market moves, it will affect your position. But also what you need is a good solution sitting above it. And fortunately, base sales process, we believe in Polaris, we have a very good solution for you, a dashboard solution. It manages by exception, and that's what you're going to have. It drives you to the sensitivity of the risk aspects within your book. And again, that is what you need. You need to have visibility of what's happening. You don't want to have a phone call coming to you or a report the next day saying that you've got problems in your underlying liquidity. You need to have that proactively managed. And again, what you need is the details of where that is happening within your balance sheet. So it's no good getting the information and you haven't got the detail. So what you're able to do within our solution is physically drill down into the detail, to the transaction level, to the trade level, and come up with a strategy of how to hedge that. Because it's all about coming up with a solution to your problem, covering it as quickly as possible so that you don't have the P&L risk there. You don't lose money. The longer you take, the more it's going to cost you. But also, the longer you take, the more chance you've got of acceleration within your risk process. And the fact that you may have to go to your central bank or regulator and say, sorry, we've busted our limit, which is no one wants nowadays. Again, as I said in the States, nobody wants to go anywhere near that. The buffer is the hard limit. So again, you're going to have to manage it proactively. And this is our solution. Apologies for hard selling, but what this allows you to do is see where the issues are. Red is bad, blue is good, big is bad, small is good. It's all about visually interpreting what's going on in your underlying rules, regulations, metrics and measures. It's pinpointing where the problems are, where the issues are. And what you're able to do is proactively manage that. We can link it to email, to SMS texts, to pop-up messages. You can link it to iPads, to iPhones, on the web. So you can get all of this information on the move, but it is giving the people at the decision level, at the C level, the information they need to make the decisions. The quicker they get the information, the quicker they can actually process it. And also, hopefully, not lose as much money or have to go to their central regulator or central bank to cover their backside. So what this does is allow you to have, as it says, as the total says, 360-degree view of everything that's going on. So it allows you complete management, complete awareness. Yes, it does need to link to your underlying systems, your underlying data. But again, we have a team that can do that. And that's what you'll need if you're going to move forward. Sensible, intelligent ways of integrating that data into an overall risk solution that gives you visual awareness. So on a real-time basis, you can see what's going on. You can come up with the processes to cover. And again, we have many different views of it, and your process should be linked to the 17 principles, okay? To LRM, to your risk potential, to your ratios. You should have different indicators, different drivers, and the ability to drill down to the sensitivity. This is the key thing behind it. But also what you need to do is have the ability to configure and customize to country risk potential, okay? Because potentially each country is going to have a different role. The US has, UK, Europe. They're all changing how it's managed. So no one's potentially sticking to the Basel III principles exactly. So you need to be able to have flexibility in that and adopt that into your report. So you need to have customized reports as well. So again, our solution allows you to do that. But the key thing is it's driving you to where the issues are within your process, and you can manage by exception management. And we have numerous different views as to how you can look at this. But the key thing is it's proactive, it's pushing the exception management out to you, making you aware of what's going on. So that's the key thing. So you're changing from reactive to proactive, the key drivers. So thank you very much for your time. That was a quick overview of how the market is progressing, how it's being pushed out globally. Does anybody have any questions?
Shall I kick things off as usual? Actually, one fascinating thing you did say, which was related to this region, you made the observation that perhaps in this region we need to be a little more creative, especially given that we perhaps don't have so many of those high-quality liquid assets. Given that, would you say, Philip, that it really brings into question perhaps the relevancy of these new liquidity regulations in some parts of the world, especially this part of the world. And perhaps instead of having standardized rules, which would be perfect in a perfect world, but as it isn't, would you really need to have very customized rules depending on the market?
I mean, I think that, and I believe that all different countries are coming up with different adherences to it. The US have come up with different regulatory aspects. So certainly I think here in the GCC and here locally, Basel needs to look at, and the regulators need to look at the different products that are being traded here, especially with the Islamic products. Because again, you've got the underlying loan linked to a commodity, linked to potentially a pool. All of that interacts together. So if you look at it as singular, that has an impact on your balance sheet. It needs to be combined. So basically, you need to have regulators stepping in and having a view of how that is going to be performed. Now, in the case of the Fed, unfortunately, in the US, many banks are coming up with new methodology, new ways of doing things. And we were in the States recently in a forum, and the banks were saying to the Fed, well, we've got this new methodology, what do you think? And the Fed was just sitting on the fence. They were physically saying, we will tell you in January. You come up with how it impacts on your balance sheet, and we will tell you if we think it works. The issue is that potentially, I think Basel and regulators don't know. They're also looking for guidelines as to how these different types of business impact on your balance sheet. So I think potentially what you need to be as a bank in the region is maybe more aggressive. Take this to your regulators, make them aware, and also tell them how you think the methodology should work. Because some of the regulators are being very acceptable to what you've got to say. They will take it on board. So, I don't think you can sit back, because if you sit back, they're going to force the issue upon you. They're going to force their rules, regulations. What you need to do is start a conversation as to how you think it should impact your balance sheet, quite honestly. Yeah.
Thank you.
And be proactive again.
Okay, do we have any more questions from the audience? No. Nope. It seems you've... yeah, okay.
When you mention integrating with the data that's already there, I know that's a load of work.
Yes.
Do you find that that there are more problems on the, let's say, the credit side than the market side in terms of getting that underlying data and problems with the integrity of that data? Or where are the biggest pain points in terms of pulling that information for your engine?
Exactly what you said. So basically, the issue is that many itinerant systems. So you've got lots of data out there, different systems all over the place. We work with Citibank. They've got 93 branches globally with many different systems. So it's an absolute nightmare. They've also got, a warehouse. Now, a lot of banks are moving away from the warehouse because basically it doesn't hold the data required to do liquidity risk management. It hasn't got the real-time, cover within it. So we're finding that a lot of banks are moving away from the warehouse. They're going back and directing, risk systems to the itinerant system. So they're going to have multiple paths to all of these systems spread out around the world because it has to be real-time. You can't wait for it to come in your warehouse and then be passed on. And also a lot of data isn't there. Your market rates, your movements, your risk potential isn't in that data. So we found that we get a lot of projects where we're having to integrate to those itinerant systems. And basically that means that we have to have a team that's very experienced and expertise in that, strong APIs, strong ETLs, but also awareness of the behaviour of how those different products perform. So we would work with customers to integrate that information in. We're aware of how it impacts on the balance sheet from prior processes. You need to bring that information in sensibly because the old adage is in, rubbish out, and you can't have that any longer. You can't say that we bust our limit by default, just because we ignored it. The regulators aren't going to stand for that. And again, just to give you an example, in the States they are running scared. They didn't want to be seen to talk to vendors just in case the Fed didn't think they had a good system in place already. So, 6 months before their due date, then they don't want to be seen that they potentially haven't got the capacity to bring in that exact information, because there is the fear that the Fed is going to make an example of someone at the start of the year who hasn't got their cover in place. And in the past, those penalties have been quite severe, as we've seen with Barclays.
Thanks.
But yes, I'd say exactly. That's the issue, is bringing in that data. Yeah.
Do we have any more questions on this particular topic? Okay. Well, okay. I think we'll move on. Thank you very much, Philip, for that presentation. Thank you very much.